Hey everybody, how's it going? Harrison George here with the Harrison George team. All right, today we're going to talk about something that's almost every homeowner has, but very few truly understand: the 30-year mortgage. It's the backbone of the American dream, and at the same time, one of the most profitable inventions for banks in history. Today I'm going to break down exactly how it works, where your money goes each month, and why it's designed to benefit the bank, not the borrower. For most people, the 30-year mortgage is the default choice. It feels safe, it keeps their monthly payment low, and it helps you qualify for a bigger home. But here's the truth. When you stretch that loan over 30 years, you're really just stretching the time in the bank's favor. You're spending so much more in interest. We're going to talk about what that looks like in an example in a second, but let me show you why the longer the loan, the better it is for the bank. All right, so let's say you guys buy a home for $400,000 and borrow that at about a 7% interest rate over a 30-year time frame. That means your principal and interest, again, you're gonna have taxes and insurance over here, and that's going to be based off of wherever you're at. We're gonna just talk about the principal and interest, because no matter what, whether month 1 or 121, those two numbers are going to add up together. Now, obviously, they're going to switch from paying little amounts in principal to a lot in principal. So let's get back to the example. Essentially, a $400,000 loan at a 7% interest rate puts your payment, principal and interest, at $2,661. It's not terrible, could be better, especially if we're talking about 3 or 4 years ago, but at least it's manageable. Here's what most people miss, is that $2,661 is not split directly down the middle with principal and interest. It is majorly weighted on the interest side up front. To get more granular, again, let's say that $2,661, you're going to have about $328 in principal and $2,333 in interest. Now, obviously, we're talking about month 1. It slowly tapers down with the interest, but I am talking slowly over the course of 30 years. And what I mean by that is that in month 242 in this example is the first month that you actually end up spending more in principal than you do in interest. 242 months, you're practically done with the loan at that point. You have about 10 years left. The likelihood of you remaining in that loan is next to none, unless if this is the dream home for you, and even then, it's possible that there could be better scenarios for you to pay this home off faster. By the end of year 1, your total payments would add up to nearly $31,900. Of that, you're talking about $3,900 going towards reducing your loan balance. That other $28,000, almost the entirety of what you've paid for that year, is going directly to the bank in the form of interest. Feels a little backwards, and that's probably because you're right, because the loan was built this way. Yes, it helped incentivize people buying homes after the Great Depression, where a majority of the population were renters, and we were trying to convert society in the United States to homeowners. And that's why this product was created. Mortgages are considered amortized, and that means the interest you pay is calculated each month based on what you still owe. So if you take a look at the screen, realistically, you can kind of see that this is not the most simplistic calculation just as a quick review. However, it's really not the most difficult calculation. So here's how the math actually works. And I'll try and keep this as simple as possible. Every mortgage payment is based on one formula that the bank has been using for essentially forever. It basically takes your loan amount, your interest rate, and your loan term, and it spreads it out over the payments of however long the time frame of the product is. Now, the formula looks complicated, but all it's really doing is making sure that early on you're paying mostly interest and later on you're paying mostly principal. For example, on a $400,000 loan at 7% with your payment at $2,661, it is then going to take the new balance in the following month. Not $400,000, it's now going to subtract out the principal that we discussed earlier, the $328 or so. It is then going to take that new reduced balance from $400,000 to $399,672, and is then going to rerun the calculation that we just posted on the screen a second ago. So as you slowly taper down the balance, you're slowly tapering down how much you're spending in interest and slightly increasing how much you're paying in principal. Very slowly. Remember, 50-50 at 242 months in this example. So let's talk about a 1-year, 5-year, and 10-year breakdown on what that interest and principal looks like. So after the first year, we talked about it a second ago, you're spending about $31,900 in total payments, where $27.9, almost $28,000 goes towards interest. Now, year 5, you're looking at a total of about $136,000 going towards interest and about $23,000 going towards principal. 5 years into it, and you've only paid your mortgage down $23,000. Let's go to year 10. Statistically, it's unlikely that an individual lives in a property past 10 years. That means you spent $262,000 of the $400,000 you've borrowed in just interest. Your principal has only gone down by $56,000. Fractions of what you've paid in interest and certainly fractions of what your total payments have been. So with that being said, you've sent $250,000 to the bank in the first 10 years for you to then go and sell your home and buy a new home and do it all over again. And that is why banks love 30-year mortgages, because most people never even make it past that 10-year mark. The average homeowner refinances or sells every 7 to 10 years, which means that banks collect nearly all of their profit up front. 7 to 10 years later, it resets when you buy a new home or refinance because you need to buy something, car, send your kids to college, or so on, and that clock just starts over. It's like pressing restart on a treadmill that's designed to always keep you running but never let you finish. Every time you refinance to save $200 a month, you start back at square one, back to paying almost all of the interest all over again. And that's the brilliance of how this amortized model traps people. It's predictable income for banks. Here's where it gets even crazier. The 30-year mortgage was designed after the Great Depression, where people mostly worked one steady job and had flat wages. Obviously, a large portion of the population rented and stayed in homes for decades. But today, income is growing much faster than it was back after the Great Depression. People have other ways to earn money. People are receiving income at an accelerated rate. Now, yes, has it been proportional to the values of homes going up? Certainly doesn't seem like that. Or has it gone up in proportion to rents? Again, certainly doesn't seem like that. For the individuals that are earning more, they are still stuck in the same system, paying the same amount of interest as everybody else. People that need to get into a home and can just do the smallest amount of money down, 30-year mortgage is perfect. But not everybody fits in the same box. We've obviously seen that in the world today. So they're forcing you to use these programs that are going to make banks a boatload of money. Again, I've worked with so many people that have said, well, this person's going to give me a 7-year ARM and it's going to be at this interest rate, 4.5, which is a great interest rate today. But they are just looking at the number. 4.5 is lower than 5.5 or 6.5. Well, yes, if you're looking at 30-year mortgage compared to 30-year mortgage, the lower the interest rate, the better. But forget all of that. Don't forget it. Just move it to the side of your brain. Look at something differently at once. Start to question, why are we doing things this way? If your income doubles, but your loan and financing don't adapt, then who's the one that's really benefiting? The adaptation is not, hey, let's give you a reduced interest rate for 5 or 6 years, and that way you'll be happy, we'll satiate you, and then you can do it all over again when that loan becomes adjustable and rates don't go down, and you got to start over. Though we'll give you another 5-year ARM, but you got to do it all over. They put you into these traps because you're the one that thinks you're getting the benefit. Ask more questions, because the bank wins every time. Now, again, I'm not saying that the 30-year mortgage is evil. It helps millions and millions of people get into homes every single year, but it's not the only way. And we've talked about this on this channel. There are smarter structures that use your income daily, not monthly, which are tools that let your money reduce your balance and interest in real time, not on the bank's schedule. And that's what we teach here. Strategies that make the bank system finally work for you and not against you. So if this has helped you see how the 30-year system really works, Obviously give the video a like, smash the smash button, not just for me, but to tell YouTube that this kind of financial education really matters. If you want to see how people are flipping the model entirely and paying homes off faster without sending extra payments in that you lose on a daily or monthly or yearly basis, check out some of our other videos. Really excited to share what we have coming up soon. Look forward to talking to you guys soon. Have a wonderful day. Peace.